Hey everyone, Josh here. If you've paid even a little attention to the news this year, you've probably noticed one thing. Markets have been moving around quite a bit. And some days are strong, and some days feel a little uncomfortable, and the headlines don't always help. So today I wanted to give you a very clear update on what's been happening, what I'm seeing in your account, and why your plan is built for exactly this kind of environment. So far this year, the market has felt a little bit like driving on a road with more bumps than usual. You're still moving forward, it's just not perfectly smooth. And we've seen more short-term swings and big reactions to headlines and lots of opinions about what might happen next. And that kind of volatility can feel a little unsettling. But it's not unusual, especially when markets are expensive like they are today and interest rates are still elevated. Whenever the markets get choppy, someone inevitably asks me, so what do you think is going to happen next? Predicting markets actually worked. This would be the most valuable tool in finance. It is incredibly so. And this is as reliable as predictions are. But jokes aside, we don't build plans on forecasts. We build them on being prepared because no one, not strategists, not economists, not anyone can consistently predict short-term market movements. And here's the important part. I've been reviewing accounts closely, and overall, I'm very comfortable with what I'm seeing. Many of you may have noticed that your portfolios haven't seen the same swings as the market overall, whether it's going up or down. And that's not accidental. Your accounts are structured based on your goals, your time horizon, and how much ups and downs you should reasonably experience. And different accounts are built for different purposes: growth, income, stability, and they're behaving the way they're supposed to. You may also notice that there's more cash. There could be a little bit more cash in your account than you're used to, and that is by design. Right now, many parts of the market are priced really aggressively, but that doesn't mean we're pessimistic. It means we're being very selective on what we do. And cash gives us that flexibility, it gives us patience, and allows us to act thoughtfully if opportunities present themselves. And we don't want to force money into places that don't make sense just to stay busy. This is the panic button, and every market cycle someone feels like pressing it. The challenge is that markets tend to punish panic and reward patience. That's why your plan is designed so we don't need this. Being balanced, having some cash reserves exist so short-term noise doesn't turn into long-term mistakes is what we want to be focusing on. There are few driving markets right now that are worth knowing about. Interest rates are still higher than what we were used to for many years, and that affects borrowing costs, valuations, and where income opportunities exist. Technology and AI are continuing to offer long-term potential, but short-term expectations can move a little faster than reality, which then creates these ups and downs that we've been seeing, and that could slow growth. And we're not seeing signs of a huge economic breakdown right now, just more of like a normal, uneven environment. And this is exactly where discipline matters most. You don't need your investments that win every quarter. No one can do that. You need one that manages risk, adapts to changing conditions, and stays aligned with your long-term goals. And our job isn't to predict the headlines, it's to build plans that hold up when headlines get loud. So whether markets move up and down or sideways from here, your plan is positioned with intention. And if you ever have any questions about why your account looks the way it does or what we're watching next, please reach out. That's what we're here for. And I just want to thank you for trusting us with something important. We will keep doing the work so you don't have to worry about the noise.